Hey traders, Raghee here, and this is your weekly recap for the Sector Secrets Mastery, starting off with our trading on June 5. I'll go through our day trades, and then we'll cover the two swing trades from this week. All right, as we go through the week, I think there'll be a theme that we will discuss, and that will be basically how we manage risk, right? Or better put, how to be a good loser. Every week is going to bring challenges. We've had 2 weeks of fantastic setups, especially day trades. This week, we didn't have that many hot zones. You'll see here, the lone hot zone on Monday was the ISM, and we were setting up the Dow as well as crude oil. And you'll notice here, crude oil, Apple, and then finally Google. Remember that we're going to oftentimes be looking at individual futures contracts as well as stocks and ETFs. Now, on the 5th, the idea was to buy Apple, as you can see here, calls, also buy crude oil, and then lastly buy Google. These were good trades. The week started off pretty good, if not a little bumpy, and ultimately we had strength in tech overall, and we had strength in energies, and it made sense to focus on the long side. So that just takes us into Tuesday. I believe that overall that spreading out between tech and energy was a good approach. And you'll see going into Tuesday, we definitely tried to do the same thing, right? So this time we went into bonds on Tuesday with the TLT 102 puts. So now we're making a bet on what? We're making a bet on higher yields, and that's why we would get short the bonds or we would buy puts. And again, the idea is to take advantage of movement lower. We didn't get much follow through, but you can see here what happened. Well, right there at 10 o'clock, right there at 10, grand opening, grand closing. So this is the first lesson in how to be a good loser. Every time we enter, we know where our stop loss is the moment that we enter. And in the case of TLT, you can see right there, buy those June 9 102 puts. When those 102 puts are down 25%, we get out. But that's one way of managing risk, okay? Another way of managing risk is to know that if there is a specific hot zone that could derail price action, we want to get out before that happens. We want to make sure we step out in front of that. That will come up later on this week. But here, we just take our stop, and that's 25% of premium paid. By the way, gang, on an agro entry, on a single entry like what we had on crude, that is 1.25%. 1.25% risk to the account. All right, taking a look here at XLF, same idea. Can we take advantage of, in this case, movement to the upside? This is now again on Tuesday. Ultimately, if we're going to buy a call, I want you to notice something that we've been doing a lot more lately, and it's been working pretty darn well. And that is, can we buy a call and have a break-even level before we get to our target? And that's been saving us these last few months, and I'm going to continue to do that. In this case, you'll notice that we bought the calls just before 10 o'clock. What happened? We took the scenic route here. All right, we took the scenic route. But if we have a buy at 32.69, as we bottom out, is that going to shake us out? Is a 19-cent move in the ETF going to shake out a 32 call? It should not, and it did not. So remember, just because something moves against our position doesn't necessarily mean that it's going to stop us out. There's a certain amount of latitude we have to give it. And that's the fine line between being a good loser and persisting with the plan, right? We always have a plan. All right, speaking of plans, that was pretty much summarizing our day trading. And then let's take a look at the two swing trades we had this week. One was in crude oil, the other was in Apple. All right, so first of all, both of these were paper cuts, which is to say we took both of these out at the paper cut loss. Lose a little so you don't have to lose a lot. We call them paper cuts because they sting, right? But we're not losing a finger here. So the idea with crude oil was to try to take advantage of a move ultimately higher. It just did not go to plan. And when we have a move like that, What we want to remember is, what do we pay for the option and what's 25% of that premium paid? USO was a setup based on the 64 call that we triggered at 64.53. And again, 25% paper cut. It wasn't quite a grand opening, grand closing, but again, we don't want to let a small loss turn into a big loss. And so that is the key. We moved on then to XOP, which brings up a different type of management. Until a trade actually reaches the level from which we want to buy it, in the case of XOP, we were looking to buy the June 16 122s. Until it reaches the level we want to buy it, we don't enter. In this case, I will say we set this up on the 5th, and we really could have set it up on the 6th again. And on the 6th, it actually reached a completely different trigger. Let me mention something here. If you took the setup on the 5th, the next day, which is not valid, you'll notice in the alert, I mentioned it's got a cutoff. Because if you took it on the 6th, well, no problem. You take it in the daily price movement range, and it was a much, much better fill. So reminder on XOP, if there's a cutoff on the fill in terms of a time, like there was on that setup, look to set it up the next day, but don't use the previous day's zone when it's a DPMR. That one worked great if you had that patience and knowledge to know the shelf life. And lastly was Apple. Apple WWDC, we waited for a bit of a sell-off, and ultimately the 180 calls were stopped out in the subsequent 1 or 2 days later, 25% paper cut. Notice something here, gang. No gaps. That's the good part. No gaps against us. And as long as there's not a gap against us, we can manage the risk. That's the week, gang. It's been one that tests our discipline. And if we have a discipline to risk management and position size, we just sail through it, acknowledge that the market didn't do what we wanted, but we're not going to be in a situation where we're debilitated from a week like this. In this update, we're going to talk about a really simple but big concept, and that is be equally comfortable with losing as you are winning. In other words, what is the key to great trading? Well, maybe it's a strategy to lose, and we're going to dive into that looking at this chart of Apple to start. The setup began with Apple in that we wanted to buy a 180 call. It doesn't matter the expiration, right? This is a concept for any trade. We wanted to buy the 180 call when essentially trades got down to 180. So an at the money call. This option, just for the ease of math, this costs about $2.90, so we'll just use $3 for the example. You get a $3 fill, or $300 per option on a $180 call in Apple. And that happened right in here. Okay. What do we do if the trade is not going in our favor? And that's a really important way to phrase it. Right and wrong, those are tough things for our brain to deal with, but what happens if a trade is going against our plan, right? It's not going our way. That's all that it is, right? Okay. Then very next day, Apple puts in a lower low. And as it sunk down to that lower low, these options fell really actually close to about $2. All right. At that point, a $3 option has traded down to $2. Now, that might sound like a small drop at first. $3 to $2. But really what that is $100 per option. Okay, here's where it's really important to think about maybe just a paper cut, as I like to call them, and losing, say, your whole hand. Paper cuts sting, but we can come back to that. We've got all 5 digits. We can get back to work, right? So I've got to be equally as comfortable with losing as I am winning. So let's talk about some definition. This is roughly, as you can see here, this is about a 33% loss. Okay, well, that's 33% on what I paid for the option. But the truth of the matter is, and remember this, a bad trade or a losing trade doesn't define you as a trader. It doesn't define your account, right? If we think about our account size, we think about this $100 in light of our account. How much risk to the overall dollars in our account are we willing to be comfortable losing, right? So again, your account size will dictate how many contracts that can be traded. So when I look at my account size, that's what's telling me how many contracts I can trade. And in this case, again, losing $1. Now, do we really want to lose at a full point or $100 per contract? No, let's talk about what I'm really comfortable with. What I'm comfortable with is about 25% of premium paid. So when I spend $2 on, or I say $3 on an option, remember, as we're bidding on the option, we know at the same time what we're willing to pay for it. 25% loss is where we need to be willing to pull it, where we need to be willing to close it. And what that allows us to do, once again, is define what a trade actually means to be not going our way, right? So good traders are what? We're good at the arithmetic of what a loss is at the very onset of the trade, and we're good losers, right? We're not sore losers. We're good losers. We're happy to be taking a small loss rather than devastated later to take a larger loss. This is the strategy, right, on how to lose. We have plenty of strategies on how to win. This is a strategy on how to lose. So when we see a trade moving lower against our plan, and remember, it went even lower still. So some traders might say, but Rag, it kind of came back. Realize that this is barely break even at that point. So when traders start to do things like add to a position, what are they really doing? They're adding to a potential and maybe even colossal loss. And at some point, there will be a trade that doesn't bounce back. And at some point, we will have the kind of position sizing based on a denial of just taking a small loss, and we'll blow up our account. That's what's on the other side of that, right? So think about 25% as a really great level to think about getting out of a trade that isn't going our way. And this is a really simple example on Apple. Let's take a look at another example. Same idea. We're looking to buy an option. We know at which price we want to buy it. And risk is determined trade by trade on what we pay for the option. So in this area right here, we start looking at the USO 64 calls. And these ran about $1.80, okay? Now, if you remember from the example just before with Apple, I'm willing to risk 25% of that premium. So I already know the moment I buy what my loss will be. So again, notice I'm getting comfortable with what the potential loss is the moment I'm getting in. I've already reconciled what that number is. I'm already knowing what the overall risk to my account could be. All right. The very next day, what do you do when a trade doesn't go our way? Well, the very next day, this particular option dropped down to about $1.50 something, $1.60-ish, right? Okay. Well, is this less than 25%? It sure is. Could I sit through this particular little dip? Right. So notice it gives us comfort to sit through unrealized loss, right? So good traders are good losers, but a loss is defined by what we paid. And as long as I don't exceed 25% of $1.80, hey, I'll just sit through the unrealized loss because I've already predefined what a quote unquote losing trade would be. All right, things start to go back on our favor, but I haven't hit my target yet. And then here comes the very next day. Well, you know that when we start trading down in this area, I've hit my risk, right? Now, in this case, there were no gaps. So prices trade in a fairly organized way down through a 25% loss of $1.80 option. And I cut my trade. That's it. Once again, if we think about what $1.80, and this is, let's talk about defining what this is. Because a lot of times, until we actually think about the loss in dollars, it's hard to really quantify. So let's take a look at that real quick. So if I pay $1.80 for my option and it loses 25%, it drops to a value of $1.35. I know that basically my stop loss for the trade is $1.35, and I know this the moment I buy. That represents, as you can see, so again, if we take $1.80 for each option, what am I risking if it drops to $1.45? 35 cents. So again, all we need to do is just crunch the numbers. The moment we're bidding on something, we say to ourselves, all right, what would 25% be? I get out, right? I know that 45 cents is the risk to my account. Now multiply that number by the number of contracts and you know your risk to the account, all on the onset of the trade. So again, if I know what a loss is, I know when to get out. Now I have a strategy to lose. I have a strategy to win. That would be my target. But if I lose that value, again, take the paper cut and get out of a trade that's not going our way. All right. So again, be equally comfortable with the strategy of losing as we are the strategy of winning. Hey traders, Raghi from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.